have you with us. Thanks for tuning into another edition of Investor's Guide, a show where we help you and guide you on how you can make your money work for you. Now, over the last few episodes, we've talked about the various categories of equity mutual funds. Today, we're going to be talking about a very interesting category called as index funds. We'll help you understand how they work and how they fit in perhaps to your portfolio. Let me go across to Feroze Azeez of Anand Rathi Wealth Management, who's joining us on this episode. Feroze, thanks for joining us. The focus today is index funds, and this is an interesting category here because of the way it really works. And especially for somebody who doesn't want the hassle of trying to figure out which fund to invest in, this might just be the right way to go about it. But first, let's understand how index funds really work, Feroze.
Avni, as the name suggests, index funds' sole purpose is to mirror the index. An index is nothing but a group of stocks like Nifty. Nifty is called an index. Sensex is also an index. Index is nothing but a group of stocks. A fund which tries to emulate the movement of an index is called an index fund, where the fund manager buys the same stocks as they are in the index in the same proportions and keeps managing it to make sure that there's minimum divergence between the index movement and the NAV of the fund. And this process of management is called a passive management, because the fund manager does not apply too much judgment or negligible judgment and only has sole objective of copying the index movement.
Right, absolutely, Feroze. And I think that's the main reason why index funds are also cheaper than any of the other actively managed funds, because there's not too much thinking or stock picking that really needs to be done. So in terms of the expense ratio, how much it costs, what would that be?
Yes, so the cost of a passively managed index fund is going to be almost 1/4 that of an active managed fund. In active managed funds, you can see expense ratios between 1.75 to 2.25. Good index funds, the competitive ones, can range between 0.3 to 0.5% of expense ratios. So they are 1/4 or 1/5 the cost of an active managed fund. And I think that straight adds to the bottom line of the investor from an investing expense and cost management standpoint.
Right. So when it comes to index funds, it does track a particular index, like you pointed out, whether it's the Nifty or the Sensex or something else for that matter. But it might not be exactly the same. There could be some amount of deviation. Why does that really happen?
Avni, that deviation has a technical nomenclature. To introduce it to the viewers, it's called the tracking error. When the fund is trying to track an index, if there is an error and if there is a difference in that tracking, that's called the tracking error. Avni, very important question: where does this tracking error come from? It comes because the fund manager might not be able to invest all of it. He needs to maintain some degree of cash element to be able to service redemptions or the inflows. That could be one primary reason. The second is the index weightages change as the market caps of each of these stocks change. When the fund manager is trying to replicate the index, may not have the second decimal appropriate weightage which the index carries. So these are the two primary reasons why tracking errors actually exist. And they could be as much as 1% a year to 1.5% a year in certain cases.
Right. Now, Feroze, when it comes to sort of, investors who are perhaps looking at index funds as an option, there are both pros and cons when it comes to this category of funds. What would you say they are, and who would this category be suitable for?
This category of investment is suitable for one who does not believe in active management, who does not have the wherewithal and the capability to choose the best active managed schemes, because active managed schemes could be as many as 400 in the equity category. Choosing the 5, 6, 7 of those itself is a nightmarish task. If an investor believes that he does not want to take the risk of choosing a fund manager, an index fund comes very handy. Second, anybody who's very cost sensitive and is a very, very long-term investor, like in the US where you say long-term is 15, 20 years, an index fund and the cost saving can be a very big advantage. but one who believes that India is still not a very, very mature market and has the potential to generate the extra return which application of mind can create, which we have seen happen. Active managed funds would be a better choice. And I think the next 5 years, personally believe that active managed funds have a huge potential over passively managed funds.
Yes, absolutely. And in fact, that was the question I wanted to ask you to take that point forward, because as of now, we have about 37 index funds that are available in the market today, and it has a combined AUM of about 13,000 crore, which is honestly not that big an amount, especially when we look at some of the other countries around the world and how index funds are used there. What do you think, the future of index funds is going to be for India, and especially how investors view this category of funds?
Avni, I think the index funds over the next few years, I think we are 5 years ahead. I think 5 years from now, the Indian market would be far more mature than what it is today. And then the passive managed funds or the index funds AUMs will increase and will have a lion's share or a reasonable share, and not as small as 1%, which is what it stands today. So it will grow. Point two is cost. Of course, cost sensitiveness will increase in the educated investor. Again, that is going to be a positive sign for passively managed funds. And I think third, the innovation in the ETF market has been very low. Like, for example, Motilal Oswal has launched a mid-cap index ETF. Otherwise, most of the ETFs are revolving around Sensex and Nifty, which I think is a big disadvantage. And as the product providers, asset management companies, expand their bouquet of ETFs to the mid-cap and the small-cap indices or any thematic index, I think interest levels will exponentially go up.
Right, absolutely, Feroze. So perhaps it's fair to say that if somebody has, that long-term belief that the Indian stock markets are going to only go up and don't want the hassle of, picking out any kind of funds, index funds, might just be the right way to go.
Yes, Avni, I think I absolutely very well summarized, and that's exactly what I would concur with.
All right, Feroze. On that note, thank you so much for joining us on this edition of Investors Guide. Well, that was all that you needed to know about index funds. So if that makes sense for you, then you can go ahead, read up more about it, and then look at investing through index funds. Thanks so much for tuning in.